the prices of American and African crude grades are rising due to disruptions in shipping in the Red Sea and the Suez Canal. Additionally, the global Brent oil benchmark is becoming more backwardated, indicating tighter markets and an increase in diesel prices in Europe. Since the embargoes on Russian petroleum went into effect early last year, Europe has been left open to increased supplies of fuel and crude from the Middle East and Asia, and is now searching for deliveries from close producers. A growing amount of petroleum goods are now traveling via the Cape of Good Hope in Africa rather than the Suez Canal, which is the shortest route from Asia and the Middle East to Europe. This lengthier route causes shipping rates to increase and delays scheduled deliveries of petroleum products. Europe is purchasing more US and West African crude as a result. According to dealers speaking with Bloomberg, the price of US and Nigerian crude grades is rising, and the backwardation in Brent crude futures is getting steeper due to a growing demand for the so-called Atlantic barrels in Europe. When there is a market shortfall, backwardation usually happens, and front-month contract prices rise relative to those further out in time. Analysts point out that the wider backwardation curve indicates a tightening market, implying that supply may be more constrained than implied by market sentiment and the movement of oil prices. To sustain oil prices, analysts anticipate declines in global stocks this month and the following one. However, they are unsure of how long the tightness would last because OPEC Plus's impending decision on whether to extend the cuts or not, spring refinery maintenance, and demand concerns could all upset the existing supply-demand balances in the market. The cost of Egina and Forçados, two important Nigerian grades, has increased recently as Europe looks to buy crude with faster and safer supply routes. Based on estimates from Bloomberg, the two West African crudes are now being offered at premiums to dated Brent that are higher than the premiums from 1 month ago. Europe has also shown a strong demand for US-grade WTI Midland, and in recent weeks, the price of oil has risen relative to the North Sea benchmark. French supermajor Total Energies has been bidding almost daily for WTI Midland supply in a price window since the beginning of February, according to trading sources cited by Bloomberg. The lack of diesel in Europe is also a result of reduced European refining capacity, partial refinery shutdown, and spring refinery maintenance, in addition to disruptions in Red Sea shipping. The differential between diesel and crude prices has increased recently, reaching its biggest point for this time of year in over 10 years, since 2012. We expect to see a fall in Northwest Europe diesel/gas oil stocks over the next 2 months, Wood Mackenzie analyst Emma Hausham told Bloomberg, citing the disruption of Red Sea oil deliveries to Europe and spring refinery maintenance. Due to supply constraints brought on by disruptions in Red Sea shipping, diesel prices in Europe began to rise last month, raising concerns about the endurance of the continent's economies, which have just about avoided recession in recent months. Since Russia's invasion of Ukraine, the European Union has banned Russian crude oil and refined products, causing severe disruptions in energy flows and a shortage in the middle distillate market in Europe. The Houthi attacks in the Red Sea are affecting these flows, making Europe more reliant on Asia and the Middle East for supplies. ING analysts Warren Patterson and Eva Manthi wrote in a note on Tuesday. They also stated that as refineries enter maintenance season, middle distillates, particularly diesel, are anticipated to continue to be well supported in the near future. The trend this year has been for the spread to move into deeper backwardation, suggesting that the market is tightening, according to ING's strategists, despite the prompt Brent time spread weakening on Monday. This quarter, the oil market will witness a slight tightening with a very minor deficit, but if OPEC Plus fails to carry over some of its cuts beyond Q1, this might turn into a surplus in the second quarter, predicts ING. In the first quarter, Saxo Bank projects that WTI and Brent would trade in a range around $75 and $80 per barrel, respectively. But at the end of last week, Ole Hansen, head of commodity strategy at Saxo Bank, said that disruption risks, OPEC Plus production restraint, a tightening product market and incoming rate cuts potentially leaving the risk/reward skewed slightly to the upside. As a result of Houthi attacks on ships in the Red Sea and the Gulf of Aden, as well as Ukrainian strikes on Russian refinery equipment, distillate supplies have been hampered, according to Hansen. According to Vortexa, global onshore inventories continued to decline in January, despite total exports declining by the most since August 2023. This suggests that global supply of crude is becoming scarce. According to an analysis published last week by Jay Maru, head of Market Intelligence and Analysis, MENA, at Vortexa, the overall amount of oil and condensate exports decreased month over month by over 700,000 barrels per day, BPD, in January, with the exception of Iran and Venezuela. This was a sharp reduction following a small upswing in December. There is still a significant drawdown in inventory, indicating that tighter prompt availability is outstripping wider macroeconomic concerns and its impact on demand, according to Maru. Even with clear indications of declining global product demand, the near-term outlook for petroleum prices may be more positive than the present mood indicates, given market expectations that OPEC Plus production will stay limited. Last week, Brent crude finished near $82, above $81 per barrel. Compared to the beginning of the week, when the international benchmark was trading at about $78 per barrel, this was a significant increase. However, these costs are essentially unchanged from what they were when the Houthis of Yemen started assaulting ships in the Red Sea. The decision by Saudi Arabia to halt efforts to increase its production capacity was likely influenced by the obviously abnormal price movement, which also added to the already widespread skepticism among investors regarding the oil industry's long-term prospects. It also led to complacency among oil traders. Furthermore, complacency is harmful, due to the fact that there are already warnings that things could change quickly and the situation is highly dynamic. Oil prices actually decreased when the Houthis attacked their first ship in early November. From over $90 per barrel of Brent in late October, the price had dropped to about $77 per barrel by early December. Since the Houthis were not aiming for oil tankers, there was no need to be concerned about an interruption in supplies in the Red Sea. The remarkable part is that prices did not increase even after they attacked an oil tanker that carried fuel for Trafigura. Benchmarks remained obstinately limited to a range. In the oil markets, the general consensus was that there was enough supply. Indeed, there seems to be an excess of oil on the market. That feeling was based on some pretty solid reasons. First off, despite talks regarding a truce, worries of an Israel-Hamas war escalation have diminished. It is thought that the likelihood of an interruption in the oil supply is inversely related to the probability of escalation. There is also the argument of spare capacity, which was brought to the market's attention last week by ING analysts who stated that OPEC possesses approximately 5 million barrels of spare production capacity. 3 million BPD of this came from Saudi Arabia. It seems that traders believe that if there is a disruption in supply in the Middle East, the Saudis will intervene to aid. However, historical evidence suggests that they may not. Prices surged into the triple digits back in 2022 when sanctions threatened to destroy several million barrels of Russian gasoline and oil. Concerned about soaring retail gas prices that summer, President Biden pushed Saudi Arabia to increase output. After giving a response akin to "we'll see," the Saudis took no more action. If prices rise for whatever reason again, there's a good chance this will happen again. It will happen again since Saudi Arabia has been making unsuccessful attempts for months to raise prices. The market's refusal to accept the idea of demand exceeding supply is a result of forecasts such as the monthly oil market report from the International Energy Agency, which frequently underestimates trends in demand. For example, the IEA has projected that oil demand would rise by 1.2 million barrels per day this year, while supply is expected to climb by 1.5 million barrels per day. The Red Sea situation has had a notable, and quite literal, impact on oil consumption, which has not been taken into account in the estimations. Travel times between Asia and Europe are extended by more than a week when ships are rerouted from the Suez Canal to the Cape of Good Hope. Petroleum fuel is used to power the vast majority of these vessels. The rerouting directly raises the demand for oil, increasing it by about 200,000 barrels per day so far, an unidentified source told Reuters' George Hay and Yan Chen. Thus, rather than growing by 1.2 million BPD as predicted, oil consumption this year will most likely climb by 1.4 million BPD, if not much more. Furthermore, the supply from non-OPEC sources is never guaranteed. While U.S. production growth is typically the focus of supply estimates, the U.S. Energy Information Administration stated that it anticipates a significant slowdown in production growth this year. To be fair, the AIA has been proven to be incorrect in the past, much as the IEA, but it is still prudent to monitor the more bleak projections for the near future. Standard Chartered, on the other hand, issued a warning earlier this month suggesting that the world's oil supply would be considerably more constrained than previously thought and that the market might see a 1.6 million barrel per day deficit as soon as this month. Furthermore, it's not the only one. The AIA projects a bigger than Standard Chartered oil supply shortfall in February, estimated at 2.3 million barrels. Ironically, the consequences of the Red Sea issue are what keep prices in check. Trade between Asia and Europe has increased in cost due to lengthier travel times, which has hindered the growth of commercial activity and, as a result, kept oil prices low. Thanks to the rise of algorithmic trading, this appears to be working for oil traders for the time being, who seem to be more interested in economic updates than in news from the oil business. The majority of analysts continue to caution against the possibility of a Middle East escalation. Oil prices are where they are because there is a risk, but it hasn't materialized yet. There doesn't seem to be much interest in things getting worse. And that's excellent news for those who use oil. And that's it. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.